Jim, it's great to have you back on the show. And that's exactly where I want to start with you. The fact that we saw the 2-10 spread go positive today. What does that signal about the state of the markets? And at a time where you have growth fears and recession fears pricing into the bond market, how do we think about this as an indicator?
My friend, Jim Bianco, I think was among the first to point out that what matters with the yield curve is not so much whether it is inverted, that is to say, whether long rates are higher than short, but rather what matters is the time in which it uninverts, in which the short rates fall under the longer rates. All of which is to say that that when the Fed decides, or the market decides for the Fed, that the economy needs some monetary jolt, the 2-year yield will plummet, and it will, on form, fall beneath the 10-year yield and longer-dated interest rates. And the uninversion is this inflation, this sometimes reliable, like all other indices, sometimes reliable recession indicator.
And so, speaking of the word JOLTS came in softer than expected today. We had Beige book this afternoon showing consumer spending tick down in most districts, that you're seeing those signals of cooling growth, waning inflation. Is the case for a 50 basis point cut by the Fed later this month now on the table?
Oh, I expect it is. I mean, now the Fed, this is a very interesting moment, isn't it? By some reckonings, the Fed is not restrictive and never has been. The Fed's own financial conditions index, the one produced by the Chicago Federal Reserve Bank, has never once registered stringency since 2022 when all this tightening began. But you can see evidence of stringency in, for example, the sharp rise in bankruptcies in the first half of this year. You can see it in the fact that, according to a survey by Lincoln International, in the second quarter, of like 5,500 private equity firms, 2/3 of them showed that they bore interest expense or debt service costs greater than free cash flow. So there are plenty of signs of stringency, not least, of course, in housing and commercial real estate. And yet, as we see by record high valuations in the stock market, there are also signs of great monetary accommodation. So the Federal Reserve, of course, has an impossible job. It kind of asks for it. It deserves it. But it is not meant to be, but it has become a central planning outfit as much as a classical central bank.
Jim, if I recall correctly, first half of the year, you were iffy on, do we get 2 rate cuts? I take that to mean probably 50 basis points worth, or a hike. It could go either way. Now the market's expecting 100 basis points worth of cuts this year, I believe. Which is closer to right?
Well, the market insists on being bullish. It indeed is pushing the Fed in that direction. I expect the Fed wants to be loose, wants to be looser, and it will cut. I had thought, and I still believe, that inflation will be much more persistent than the market seems to expect. It seems to me that in a democratic society, in a social democratic society, inflation resembles kind of an underground coal fire in Virginia, the kind that flames underground for years and years, and you feel it periodically in the soles of your shoes, and then once in a while it bursts above the surface. That to me is inflation. Inflation has been defined by a very great economist I know as a continuous overstraining of a national economy, and I think that's what we're looking at. Look no further, for example, than our presidential candidates for this season. Donald Trump is out with his vice presidential nominees, saying that they would cut taxes to the tune of $10.5 trillion over 10 years. $10.5 trillion. So there is a whole school of economic thought that inflation is a fiscal phenomenon. John Cochrane is responsible for that idea. And if that's so, I think that inflation is clearly on the agenda. And there are many other reasons as well to expect. The more they cut interest rates, the more it helps inflation-sensitive sectors of the economy that heretofore have been helping inflation readings dwindle. But it strikes me that if the Fed eases as much as the market expects, and the market is very, very bullish indeed, that inflation is likely to find itself in the receipt of a monetary stimulus once more.